Hey everyone, welcome back to Corporate Decoder, the place where we unwrap the hidden stories in corporate reports. And today we're diving deep into the Select Sector Spider Trust's latest shareholder report. It promises some interesting insights into how these sector-specific funds performed, especially with all the buzz around AI and market shifts. Let's see if these sector bets paid off or if some investors got left behind before we start. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below to keep the conversation going. So right off the bat, this filing from the Select Sector Spider Trust covers the period up to the 30th of September 2025, and it includes reports for 11 different sector-specific exchange-traded funds, like the Communication Services Fund, the Consumer Discretionary Fund, and the Technology Fund, which you know has been a hot area lately. We're going to cut through the details and focus on what matters most: the performance, the costs, and where the money is actually invested. First off, let's talk money. What did it cost to invest in these funds based on a hypothetical $10,000 investment? The costs were pretty minimal for most of these funds. It looks like about $9 or 0.08% for the communication services, and consumer discretionary funds, the energy, financial, healthcare, industrial materials, and technology funds also came in at around $8 or $9 for that hypothetical $10,000 investment. That tells us these sector funds are generally efficient from a cost perspective, which is good news for investors watching their expenses. Now for the juicy part, performance, and what drove it: the Communication Services Fund had a strong year despite some initial market volatility from tariff wars. Their performance was largely boosted by artificial intelligence related investments and strong showings from tech giants like Alphabet and Meta platforms. Even though broadband providers helped stabilize things, the report states that the stock prices went up quite a bit from what they were worth when the fund was first created, which is a good sign for investors. Let's look at the numbers for the Communication Services Fund. XLC, an initial $10,000 investment made on the 18th of June 2018, was worth a whopping $25,355 by the 30th of September 25. That is a fantastic return over that period compared to the S&P 500 index, which grew to $27,166 over the same time frame. The Communication Services Index itself performed even better, reaching $25,514. That outperformance is quite noticeable. The consumer discretionary sector also had a dynamic and volatile year, with 3 rate cuts in late 2024 and another surprise cut in September 2025, giving investor confidence a boost. Despite some inflation worries, the Consumer Discretionary Fund XLI also saw a solid increase in it. IL 10,000 investment from the 30th of September 2015 grew to $35,989 by the 30th of September 2025. That is an impressive gain, and while the S&P 500 index also did well, growing to $41,530, the consumer discretionary sector index itself finished even higher at $36,400. $40. This suggests that the focus on consumer spending, especially among higher income households, really paid off for this sector. Consumer staples, however, had an underwhelming year. The S&P Consumer Staples Select Sector Index actually lost 3.01% over the period, lagging the broader market significantly. Investors were more focused on growth stocks and AI-related investments, and the appeal of dividend yields was dimmed by higher interest rates plus companies in this sector offered cautious outlooks reflecting unpredictable consumer behavior. So a $10,000 investment from the 30th of September 2015 was only worth $17,654 by the 30th of September 2025, which is a stark contrast to the other sectors. The energy sector navigated a complex landscape with shifting global dynamics and evolving policy signals. Investor sentiment remained cautious due to geopolitical tensions and fluctuating commodity prices, but the sector showed resilience with disciplined capital management. The Energy Fund XLE saw its $10,000 investment from the 30th of September 2015 grow to $21,817 by the 30th of September 2025. This was actually a positive gain, but it significantly underperformed the S&P 500 index, which grew to $35,315 over the same period. The Energy Select Sector Index also lagged at $21,091. This sector was clearly not the star performer this year. The financial sector, on the other hand, posted a solid total return of over 20%, supported by improving earnings and investor optimism about long Term growth banks saw their net interest margins expand, and diversified financials and insurance also contributed positively. The financial fund XLF started with $10,000 on the 30th of September 2015 and ended up at $35,411 by the 30th of September 25. Again, this performance lagged the S&P 500 index, which reached $41,530, indicating that while the financial sector did well, it was outpaced by the broader market, which makes sense given the significant gains in tech-driven areas. The healthcare sector, interestingly, was not a primary driver of equity market outperformance, despite the broader market's positive trajectory. The healthcare select sector index actually ended the year with a negative return of 7.95%. This underperformance highlights investors' focus squarely on technology and AI themes. During this period, the healthcare fund XLV started with $10,000 on the thigh. 30th of September 2015, and was worth only $9,941 by the 30th of September 2025, a clear loss. Industrials had a strong year but underperformed the broader S&P 500 index, largely due to the AI boom benefiting other sectors. Aerospace and defense was the top performer, led by General Electric Aerospace, which hit a record high, but United Parcel Service lagged due to weaker delivery volumes and rising costs for the industrial fund. DXILE, a 10,000 investment from the 30th of September 2015, grew to $36,965 by the 30th of September 2025. This is a solid gain, but still below the S&P 500 index's $41,530. The materials sector navigated a challenging year with macroeconomic headwinds and a slowdown in China weighing on sentiment, but it found support in stimulus measures and easing monetary policy. Commodity linked industries like copper and gold benefited despite volatility. The materials fund XLB saw its $10,000 investment from the 30th of September 2015 decreased to $27,461 by the 30th of September 2025. Again, this is a significant underperformance compared to the S&P 500 index, which more than quadrupled that initial investment. Real estate performance was mixed. The fund declined nearly 8% in the first quarter, but recovered about 6% over the remainder of the period. Welltower Inc. was a top contributor, benefiting from demand and limited supply, but American Tower Corp lagged due to operational challenges. The real estate fund XLRE started with $10,000 on the 7th of October 2015 and ended up at $19,840 for the same period, a much lower return than the S&P 500, which reached $41,530. And finally, technology. The star of the show performance was driven by AI-based growth innovation and positive earnings despite market concerns. The technology fund XLK saw its $10,000 investment from the 30th of September 2015 skyrocket to $80,002 by the 30th of September 2025. That is an explosive return, beating the S&P 500 index, which finished at $41,530, and the Technology Select Sector Index itself, which reached $81,220. This sector clearly led the pack. Looking at the key numbers as of the 30th of September 2025, the Technology Sector Fund XLK dominated with $90 billion in net assets. The Communication Services Fund XLC had $27 billion, and Consumer Discretionary XLI had $24 billion. Consumer Staples XLP had $16 billion. Ion Dollars Energy XL and Materials XLB were also substantial, but Real Estate XLRE was the smallest of these sector funds at around $7.8 billion. Strikingly, the Technology Fund had a portfolio turnover rate of 5%, suggesting a buy and hold strategy for its dominant AI beneficiaries, while others like Communication Services had a higher turnover of 40%, reflecting more active adjustments. Let's peek under the hood at the top holdings for the Communication Services Fund. Meta Platforms Inc. and Alphabet Inc. with their Class A and Class C shares made up a huge chunk of the portfolio. Nearly 30% combined. Netflix and Warner Bros. Discovery were also significant holdings in the technology sector. Nvidia Corp and Microsoft Corp were the undisputed leaders, making up over 25% of the holdings combined. Apple Inc. and Broadcom Inc. also featured prominently. The energy sector was heavily concentrated in oil, gas, and consumable fuels, with ExxonMobil Corp and Chevron Corp dominating nearly 41% of holdings together. Now for some important forward-looking news effective the 1st of December 2025. All these funds are changing their names to State Street Communication Services, Select Sector SPDR ETF, State Street Consumer Discretionary Select Sector SPDR ETF, and so on. This suggests a rebranding of sorts, and SSGA funds. Distributors LLC will replace Alps Portfolio Solutions Distributor Inc. as the distributor. The websites are also changing from sectorspifdar.com to ssga.com. These changes are not expected to alter the fund's investment strategy or risks, so it is more of a name and operational shift. So what is the verdict? First off, the technology sector, especially driven by AI, was the undisputed winner this year, demonstrating massive growth and dominance. Nvidia and Microsoft have become giants shaping the market. The communication services Sector also performed strongly driven by similar tech trends, but showed a bit more volatility. Consumer discretionary had a good year too, bouncing back from an initial slump. But it's clear that defensive sectors like consumer staples and utilities, while offering some stability, really lagged behind the growth-oriented sectors. The energy sector showed resilience, but was outpaced by the broader market and healthcare, while important lagged significantly due to the market's intense focus on tech and AI. This filing really highlights how sector-specific investments can lead to very different outcomes, and with the rebranding to State Street SPDR ETFs coming up, it will be interesting to watch how these funds evolve. Overall, the market was clearly favouring growth and innovation this year. If you were betting on AI or tech, chances are you did very well. But if you were in more defensive or traditionally stable sectors like consumer staples or utilities, it was a tougher year. The real takeaway here is the importance of diversification, not just across sectors, but also understanding the underlying drivers of sector performance and being aware when a particular theme like AI can create such a dramatic divergence. In returns, what is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord linked in the description for more great discussion and insights. Thanks for watching. See you next time.